The 2008 credit crisis, also known as the global financial crisis, was one of the most significant economic events of our time. It was a period of financial turmoil that began in the US and quickly spread to other countries, causing a global economic downturn. Process. In January 2008, the government joined in vain to stop the declining of households with policies such as lowering the federal funds rate and tax rebates. In March, the Federal Reserve held an emergency meeting to rescue the Bear Stearns in crisis. In July, Congress passed the Housing and Economic Recovery Act, enabling the Treasury to guarantee $25 billion in loans held by Fannie Mae and Freddie Mac. And later, they were nationalized on September 7th. But on September 15th, the bankruptcy of Lehman Brothers spread panic across global markets, triggering a full-blown financial crisis. The spread of the crisis triggered a massive bank run, sharp falls in global stock markets and oil prices. Global financial markets shrunk. Reason: the crisis was triggered by a combination of factors, including the housing market bubble, lax lending standards, and the proliferation of complex financial instruments that were poorly understood by investors and regulators. The subprime mortgage market was at the heart of the crisis. Designed to provide loans to borrowers with poor credit, banks and other financial institutions packed these subprime loans into mortgage-backed securities and sold them to investors, who were attracted by the promises of high returns. However, as the housing market began to decline, many of these subprime borrowers were unable to make their mortgage payments, leading to a surge in defaults and foreclosures. This in turn caused the value of the mortgage-backed securities to plummet, leaving investors with significant losses. As the crisis deepened, many of the financial institutions that had invested heavily in these mortgage-backed securities were themselves in trouble. This led to a loss of confidence in the financial system and a sharp decline in the value of stocks and other investments. Countermeasures. To prevent a total collapse of the financial system, the US government stepped in with a series of measures, including the Troubled Asset Relief Program, TARP, which provided funds to stabilize troubled banks and other financial institutions. Meanwhile, the Federal Reserve has taken a series of emergency measures to stabilize financial markets, including lowering the federal funds rate, providing liquidity support, and buying treasury bonds. Conclusion: the 2008 credit crisis was a painful reminder of the risk and complexity inherent in our financial system. It exposed weakness in regulation, oversight, and risk management, and highlighted the need for greater transparency and accountability in the financial industry.